Good afternoon, and thank you for joining us at Metropolitan Capital today. My name is Cheryl Parrish, and this webinar is about looking ahead, what you can expect moving forward. Speaking today will be Sharon Snow and Dave Schomburg. I'll turn things over to Sharon and Dave in just a moment. MCS is pleased to report that we are highlighted in a new book entitled Winning ETF Strategies by Max Isaacman. In addition, among many professional ranking awards that we have won over the past 5 years, the 5-star ranking by Morningstar is the highest that can be awarded. Every year since inception, 2007, MCS has been in the top 2% of all U.S. money managers. Now, a few housekeeping issues. Everyone will be placed on mute during the webinar. Questions can be submitted online for discussion at the conclusion of the webinar. And lastly, we will be recording today's presentation, and the link will be available soon on our website. With that, I'll turn things over to Sharon.
Thank you, Cheryl. So to put things in perspective, if you have been an MCS client over the past 6 years, your investments have grown. Not many people can say that. At MCS, our clients' portfolios have grown because we have never lost our clients' money. Remember, we, and that's all of us as investors, don't deserve to be called investors unless we're in the market for a full investment cycle. Otherwise, we're gambling, which MCS does not do. It's easy to forget the market has been flat over the past 12 years. In fact, we first hit 1360s, which the market's at today, as defined by the Standard & Poor's 500, in 1999, a decade ago. The MCS investment philosophy has never changed. Our goal is to capture the strong rises and avoid the roller coaster losses. We believe we can identify profitable entry and exit levels during the cycle. This has been proven by the 6 entry and exit points over the past 6 years with our outstanding results. Timing in life is crucial. We only commit our clients' capital and our capital when we can identify a 10% investment opportunity and we have the corresponding high confidence in that rise. We say our confidence must be 90% or greater. If we don't have both of these identified, we protect the asset. We stay in the lowest risk asset class, typically money markets. We need to remember that not all upward market moves are the same. We just had a 10% market move since the end of last year. That move had extreme high risk associated with it. If MCS participated in all market upturns, we'd also participate in all the downturns. We've never lost money or participated in the downturns. So to put that further in perspective, in a typical 5-year period, MCS will only participate in 5 to 8 of those double-digit upsides, while there might be 10 or 15 market rallies during that same time period. We all know the market moves in cycles. We have bull and bear market cycles, business cycles, and the cycle we're currently in. That's the depression or severe recession. It's lasted for 11 years so far, and typically it goes for 16 to 26 years. What these cycles mean is during almost every year, we're going to have a double-digit downside. Our clients want a smooth ride and a step up in their portfolio values when it's safe. So to talk about the next opportunity or the next step up, let me turn it over to Dave.
Good afternoon. 2 of our primary concerns are still the excess money printing by the central bankers and the excessive debt in the U.S. and European countries. Now, these concerns are creating opportunities for the MCS tactical strategy. For example, we expect interest rates to rise, which will give us a play in the bond market in the future. Now, in the equity market this year, there will be pockets of opportunity to exploit, regardless of the direction of the stock market. And third, inflation is high on our radar, which will provide an entry point into gold or other commodities at a point in the near future. Now, the good news is that the stock market is currently settling into a definable channel, and therefore our confidence level is rising. This highly indicates that there will be an opening forming to invest in the market with the potential for double-digit returns and an associated low risk along with it. I'll turn it back over to Sharon.
So that's really what makes MCS different. We go to different asset classes and we provide protection. So to sum up what Dave said, in the short term, we have confidence in a rising equity market. That means the U.S. market and perhaps emerging markets. In the midterm, we have a bond play forming when interest rates rise. And we also see a play in the commodities or precious metals like gold. In closing, our confidence is rising for the next entry point. So we're getting close, and stay tuned, especially the clients who missed our last big step up in 2010. And we want to say a special thanks to those who have referred family and friends for protection and growth. So now let's open it up for some questions.
All right, Sharon, we do have a question, and the question is, why don't you have more action? I'd like to see more activity in my account.
Well, everyone implies that activity has a positive result, and that's certainly not been the case over the past decade. If we had more activity, we would have more losses, and we don't tolerate losses. We wait until the time is right to make a move, and that time's becoming very close.
Okay, we have a second question. What signals are you looking for in order to make a move into the market?
We always look for the same things. We look for a confluence of the technicals, the fundamentals, and the economic indicators. They all have to align. There's no magic bullet because the numbers change continuously. If Greece defaults, it changes things. If earnings get lowered, it changes things. The numbers always change. So all three have to align: technicals, fundamentals, and the economic indicators.
Thank you, Sharon. The next question is, how would a Greek default affect MCS and our accounts?
A Greek default would mean more European countries defaulting. It's just a lack of confidence in Europe. That could imply an implosion and a possible entry point for us to get into the market. Right now, we've had a lot of money printing all over the globe, and the banks have been shorn up based on that money printing. So we really don't expect it to affect any of the brokerage accounts at this point. If that changes, we'll alter our forecast.
All right, thank you. Another question is to please define the near future.
The near future is from right now to 6 months, and usually within 3 months. And I'm sure that's relating to when are you going to get in the market. So that's the near future to us.
All right, we've got a couple questions coming in. We're going to wait just a minute. All right, this next question, how about sitting in short-term treasuries instead of cash?
I'm not sure why people would like that. Basically, we're in a zero interest rate environment. In fact, 30-year treasuries are paying about 3%. If we bought short-term treasuries, we'd have to purchase them and sell them at the right time. Again, that's implying that when we want to get into an equity play, we could sell them at a profit. A much lower risk play is to stay in the money markets and wait until we can get into the other investments we're looking at.
All right, thank you, Sharon. Next question, when will we be writing more options?
We anticipate writing more options in the very near future. The very near future is within the month. We haven't written any options this year because the market's been in a topping process and our indicators have not aligned. We anticipate in the very near future, very near, writing some more options.
All right, we're going to give it just a couple more minutes for a few more questions to come in. All right, this question, do you see a point in time where bond yields will ever beat inflation?
The simple answer to that is no. Bond yields typically lag inflation with respect to the severity at a certain point in time. In a very small moment, inflation could outweigh the Treasury yields or vice versa, but typically bond yields stay below in the inflation rate on over a longer period of time. So the quick and dirty is no.
All right, I think that's it for our questions. If you have any other questions that you'd like to ask us on an individual basis, please feel free to call our office or to send any of us an email. And please, you can look at our website for the replay or the recording of this webinar. Thank you very much for joining us.
Thank you.
Thank you.